So today we're going to be unpacking exactly why rates were held with the RBA December announcement.
Yeah.
We're also going to be going through the recent APRA changes regarding debt-to-income ratios and, anything else that sort of is relevant at the moment.
Inflation's too high again.
Yeah.
The house price is already moving way too fast.
Now, if we isolate electricity over the last 12 months, so to 12 months to October, electricity prices have gone up 37%.
But then that keeps interest rates high, which keeps the cost of living high.
Raising interest rates for homeowners will not affect the price of electricity.
No.
That's one of the categories that you just cannot go without.
Yeah. Basically, inflation's too high again.
Yeah.
The house price is already moving way too fast.
Yeah.
So it's no surprise that the RBA is held again.
I think it's a smart move anyway, because obviously coming into Christmas, consumer spending is up.
Yeah.
You know, that's always a given.
Yeah.
And there's some certain factors of the inflation, I guess the inflation categories that is really driving it up.
Yeah.
And we did talk about it on a recent episode.
Yeah.
But it is electricity.
Yeah.
It still is. You know, if we break it down into simple terms, the RBA is hopeful of a ban. What is it, around 2.5 to 3%? At a guess, I don't know the exact number, but it's around that. They want it less than 3%.
Yeah.
Now, if we isolate electricity over the last 12 months, so to 12 months to October, electricity prices have gone up 37%.
Yeah. And I think there was a government rebate recently or something that they announced. They're trying to
do it again.
They're doing it again.
So that's what skewed the inflation figures last year, was the $300 that went on everyone's electricity bills.
Yeah.
And that drove inflation down.
Yeah.
Now, in my opinion, that isn't driving inflation down. That's manufacturing a reduction in inflation by putting $300.
Yeah.
They essentially just gifted a couple of $1 billion to
which is crazy.
companies.
It's like that's government allocated funds. Taxpayers are still paying for it.
Correct.
Like it's just recycling money.
And all they've done is give it to the the $300 that was given to these to the power companies to take off our bills has been absorbed by the inflation that they've done. So it was fucking pointless as far as I'm concerned to give them the $300 per consumer, but then they've increased more than $300 in most cases. So it's stupid, in my opinion. They should be looking at the actual cost of why, you know, electricity prices are going up. Yeah. You know, and start to figure out ways to make it cheaper. You know, instead of just as you said, they're proposing that they just give another $300 per person again.
It's not even a band-aid. It's like just taxpayers pay their tax. The government reallocates that money to a subsidy to reduce electricity prices.
It's literally going in one pocket and out the other.
But then that keeps interest rates high, which keeps the cost of living high.
Correct.
It's just
So they're obviously trying to reduce overall inflation. Again, I think I said this on the last one. Raising interest rates for homeowners will not affect the price of electricity.
No.
That's one of the categories that you just cannot go without.
Yeah.
So it's not directly linked to interest rates at all.
Yeah.
So in my opinion, holding it was probably a smart idea, especially coming over the Christmas period. I think realistically, you know, I personally think we're probably coming towards the end of the rate reduction cycle, but that will really depend on what the inflation figures are doing after Christmas.
That's the thing. We know that the RBA loves their quarterly data and not the monthly.
Correct.
So it's probably going to be whenever the next quarter rolls around.
December quarter, I believe we get the figures for that around February.
Okay.
So
revisit.
February, March, RBA will be the big one to keep an eye out for now.
Will be interesting to see what happens after that, because we've had probably the most significant thing in this episode is the changes to APRA.
Correct.
And so that will be interesting to see what happens, if anything changes with these new restrictions, to, you know, what happens with the interest rates moving forward, because this may have a slight effect on the property market. But for sure, like you've said, debt-to-income ratios were already capped, so it's probably best for you to touch on a little bit more about what's happening with APRA.
Yeah, so with APRA, so debt-to-income ratios, so to put that in simple terms, if you earn $100,000, this new cap states that you can only borrow 6 times that, so 600,000. Doesn't sound like much, but in the scheme of things, it actually is quite a bit.
Yeah.
So to put that into, I guess, reality, less than 6% of current loans are below, are above the current level, the capped level of 6.
Yeah.
So it's a small amount of people it's going to affect.
Yeah.
What APRA is worried about is high income or income earners that have they're just leveraged to the shit house.
Yeah.
So they're literally, there's some cases where people have been up to, well, I was reading about it, that some people have been up to like 12 and, double what they're recommending. But it's a very, very small amount.
And that's the thing. It's just, I guess it's just more regulation and protection for limiting the overall debt levels for the property market.
So they're just formalising it. And also what they've done is it's only certain banks that are subject to that as well. So I think is it the deposit taking banks? So ones that you're able to have savings at. So your big fours, your typical banks where you have a branch, you can go and put money into an account.
And I mean, this is just another thing. Like, I think Macquarie was one of the banks recently that said that they're not lending to trust anymore.
CBA as well.
So that's just another one of these things which it's only really going to affect the investor market.
Yeah. And this is all, in my opinion, in reaction to a lot of the what do we call them? Finfluencers or influencers and finance on social media and prop buyers
Unlimited
agents.
borrowing capacity.
Correct. Yous have stuffed it for yourselves, in my opinion. Spruiking, and I see it all the time from mortgage brokers and from buyers agents, thinking that buying through a trust, you're going to get this unlimited borrowing capacity.
If you can't make the repayments, you can't make the repayments.
That's so irresponsible and just a shit idea in general. Unless it is legitimately making profit
100%.
and doing well. But that's based on current interest rates. If rates go up, some of these people, we'd talk about DTIs, debt to income ratios. Some of these people were leveraged at like 10 times because of the trust structures, and the trust structures were getting excluded from new lending. Now, you put that into this perspective, one or two interest rate rises, these people are stuffed.
And that's the thing. It's like, it's great to come up with all of these strategies. I'm pretty bullish on crypto, but that comes with a risk factor with it as well. And all of these high DTIs and trust structures, it all comes with a component of risk. And they're just sort of advertising it as it's the greatest strategy for everybody, but everyone has a different risk profile.
Correct. You need to speak to an accountant or a financial planner and figure your shit out. Don't just watch someone on social media and go, I'm buying through a trust.
And risk, all of these things have been put in place because of what's happened before. Like we've seen negative outcomes before, so they're all just protections.
Rules are put in place. In general, rules are put in place to protect the dumb people. It's fucking as simple as that. Everyone's going out now, there was a huge spike in trust lending. Huge spike. Now, banks aren't idiots. They're all talking now and going, well, what's the reason for that? It's because of it's on social media. You get this unlimited borrowing capacity, which is so...
And now the finfluencers will have to create a new loophole.
Correct. So you might actually have to start declaring your debts and doing it the right way. But that's when you start moving on to second-tier lenders that are not subject to DTIs. They have different buffer rates. They've got all these different things. So you don't have to be sketchy and get false accountants' letters and all that shit. You can do it the right way. And you can build quite good portfolios doing it correctly.
I think the limitation on trust lending, these changes with APRA, it's only going to have a positive effect on the affordability issue. I still think affordability is going to be a massive issue, but those two things, the limitations, it's only going to be a positive thing.
So last one we're going to go through is the Help to Buy scheme, also known as the Shared Equity Scheme. This is the scheme that the Labor government's been parked for a few years now. Finally has rolled out, and in the spirit of competition, they've rolled it out to two banks, CBA and Bank Australia. Now, CBA is a bank that is actively trying to push brokers to the side or to basically delete them if they had their way. Now, the reason they don't like brokers is because we've reduced brokers as a whole have reduced the net profit margins or the net margins that they make per loan. Now, the reason that that's reduced is because we do what's called pricing. So you get a loan and it's at 5.5. In 6 months' time, most good brokers will ring that bank and say, can you do a better rate? Now, that reduces their margin.
Yeah,
You know,
yeah,
they're
yeah.
constantly having to compete for that loan.
Which
if they do it direct to branch, they know that most people don't do that.
Yeah.
So their margins are better. It's
Yeah.
as simple as that. So CBA, in the true spirit of CBA, has said, yeah, we'll do the Help to Buy schemes, but you can't do them through a broker.
Yeah, yeah.
So what a great rollout.
Yeah.
So they've gone, all right, we'll give it to one bank that hates brokers and another one that most people don't have access to as well, which is Bank Australia.
And on CBA, I know CBA are actually trying to actively recruit buyers agents, and they're offering pretty significant referral fees for client referrals.
100% they are.
So they're actively trying to absorb that market.
Trying to cut brokers out of the situation. And the reason being is exactly what I said. If you go through a broker, it's likely you will pay a lot less over the term of your loan than going directly to a bank.
Yeah.
And prove me wrong.
Yeah. 100%.
Prove me wrong, Mr. CBA. So basically that's it. RBA rates on hold, and I think they will be for a while. I don't see them going up. I don't see them going down. I think they'll hold for quite a substantial period now. I think the fluff around RBA will start to dissolve off, and we'll just go back to living our lives. We've got the APRA DTI, again, bit of a non-event because most people are well below that anyway.
Exactly.
And we've got the Help to Buy scheme, which either go directly to CBA and pay a shitload more over the life of your loan, or you could actually just go through them and we'll refinance you in a couple of years once your incomes go up, or come to a broker. Most brokers do have Bank Australia, not a bad bank. Get in there and start.
I do wonder, just a thought that came to mind then with the APRA, but also the first home loan deposit scheme. I wonder if that has any relation that first home buyers are only putting down a 5% deposit, and perhaps they're really pushing that.
Well, they're trying to cap that. Yes.
Yeah.
They
so
don't
I wonder if it's like an effect from that first home buyer market.
It's all in all. You know what I mean?
Yeah.
Like the problem that I've got with the Help to Buy scheme is the government owns a certain portion.
Yeah.
And you're really locked into that lender.
100%.
So let's say hypothetically they take 30%, which they do.
Yeah.
They take 30% of the equity for an existing, 40% equity for a new. Now, most people that go under that scheme is because they can't afford that 40% portion or that 30% portion.
Yeah.
So CBA, I know what CBA is like. I'll bag them out. They're going to know that you're locked into that rate or locked into that loan.
Yeah.
So what they'll do is they'll slowly creep your rate.
Yeah.
But you're locked in.
Yeah.
You can't afford to refinance. You can't afford to do anything. So the net profit margin on those loans for the lenders is going to be huge, in my opinion. So keep an eye out for that.
Yeah.
Be careful what you wish for.
Yeah.
Speak to a broker and get your shit sorted.
Yeah.
I'm a broker.
Absolutely.
Speak to me.
Yeah.
But click on the link in the link in the profile and book in a call. All right, that's it for this week.
See you
We'll
in the next one.